Everybody, Tom Gentile, welcome to a special webinar. We do this one once a year, and it's because it has something to do with a very cool pattern. However, actually, we got two patterns that are happening today, and I'm going to share the other one with you a little bit later on in this broadcast. So before I get started, if you could just give me some sort of high five sign, anything there, let me know that you can hear me, you can see the screen. Let's see. Now you can't see the screen, can you? Let's do this. All right. Can you see that screen? Hey guys, how we doing? Welcome to my trading room. Let's pan over and see what's going on in the other side of the world. Nah, I mute that for a reason. Let's come on back. Good to see everybody. All right, so enough of my smiling face. Let's go ahead and switch to what you really want to see here, which is the camera. In order to do that, I need to take control of the computer. Let me do that real quick. Now, you guys should see something coming up on your screen. Jay, let me know if you see that. I think everybody else is seeing it, but
I see your tools.
We're going to get into that in a little bit because that has a lot to do with our patterns, but energy opportunities for 2018.
There it is. There's the lead slide. Disclaimer next, I imagine, right?
Awesome. Yep, I'm going to put that up there right now, or at least I think I am. Maybe I don't have it on there. Where is it? I missed the disclaimer. Right. Okay. Well, you know what?
Sure, you got one in there somewhere.
I probably need to put that up. So give me a second. We're going to do something. This is live. This is what happens in a live webinar. So let's see if I can find something over here that might have a disclaimer on it. Here we go. Here's a disclaimer. Great. Pull one from something we did recently. So guys, glad to have you on the program. And real quick, session's being recorded. You can get access to the recording. It'll be available as soon as I can get done and have everything uploaded to you. We'll have it emailed out to you. Also, you can ask questions here in the live event. That's what you get for being here live. Ask me questions. I'll let you know right now, we got a lot of people in the room. So if I don't get to your question, I apologize. We'll try to get to the most popular questions that are out there. Finally, disclaimer you see on the screen. Remember, you can read this from beginning to end on the recording, but a couple big things. Stock and options trading has large potential rewards, but also large potential risk. Also, myself, Jay, everyone associated with Optionetics and Tom's Trading Room, we're here as your educators, and we're here to show you how we trade, and most importantly, how we trade patterns. All right, because of that, we're not personal investment advisors. I do not give specific trading advice. All right, that's between you and your broker or investment advisor. Everything I'm going to talk about today is in US dollars unless noted otherwise. And that is it for the disclaimer. So thank you very much there. Let's go ahead and pop over to energy opportunities, which was energy opportunities, but there's something else I'm wrapping up into this as well. So we're going to talk about, we're going to do a quick review of the money calendar for February. Okay. I want to talk about the 2018 energy pattern because it really starts right now. It starts here in the middle of February. We also are going to do a review of 3 different option strategies that you can trade this energy pattern on with 3 trade case studies. I also want to show you what's new at Tom's Option Tools because we got some pretty cool things. And by the way, cryptocurrencies is one of them. So I'm going to show you that. We got a slew of little things that have popped up here in the last few months. And I also got some things that will be coming very soon too. So all of this I want to cover with you. Let's go ahead and get started. So the money calendar, what I did was I took the better part of February, all right, today being the 15th. And, you know, if you've been on any of my webinars, and I've had several of them. In fact, we do webinars for our professional trading group Monday through Thursday during live market hours. And we've been talking a lot about the fact that we really thought the correction was going to happen in the first 2 weeks of January. It came 30 days late. Those of you that were on some of my evening sessions, we did a piece that included the puppies or the flying 5, which are the puppies of the Dow. And all those puppies, if you looked at them, say the end of January, 4 out of 5 of them were up. Then we got 2 weeks of slaughter with the markets dropping back more than 10% on average. All right, guess what? Our 4 out of 5 puppies going up became 1 out of 5 puppies being up. Well, now we're back to 3 of the 5 puppies being up, and I've got a lot of green on my screen behind me. I'm really liking what I'm seeing. I'll tell you what, when the VIX gets below 30 and stays below 30 for a good time period, I'm going to like it even more. I think that we're going to still see volatility. I said before that volatility was going to be around for about 2 weeks when this drop happened. All right, so we've gone through one of those weeks. I still think we're going to see a little bit of volatility, but we get into the last week of February, and we have not had another shock to the system in the markets. I think you're going to see these patterns come right back in and just full steam ahead. So what does the month of February have to do with oil and energies and our outlook? Well, it has a lot to do with it because in February, we get a bullish pattern on oil and energy stocks. We call it the energy cycle. The energy cycle looks like this. If you look at the long-term cycle of oil and energy, statistically, the oil and energy markets will be weaker between July to February. All right, so there's about a 7-month cycle where I'm not going to say that they're always weaker. There's just not a real pattern there. All right, but if you look between February and July, between mid-February and mid-July, there is a pattern that is actually very repeatable and very tradable. And this pattern has actually happened in 13 of the last 15 years, repeatedly in the energy markets. All right. Now, typically, this pattern will run up an average of 10 to 15%. So think about this. If we use Money Calendar a lot as we're in here teaching, and those of you that use our software, okay, you're using Money Calendar all the time. But what we also do is we layer a lot of these months across each other, and we look for the longer term patterns. It takes a little bit more work to do that, to really go back and back test some of these long-term patterns. But it's amazing how some of these long-term patterns just continue to be out there. This is one of them. Okay, the energy trade we're looking at. Now, this is what a typical trader would do in red, and this is my action plan. Typical trader that knows this pattern. And there's some of them out there that do, but maybe they don't know how to trade options on it. All right, so a typical trader will go out there and they'll buy oil. Maybe they'll buy USO. That's going to be the cheapest. All right, not always the best, but it is the cheapest. Maybe they'll buy an energy ETF like XLE. Maybe they'll buy a stock like ExxonMobil or Chevron. And their plan is to hold it until mid-July. All right, so the cost of ownership is going to vary, but it could end up costing thousands of dollars depending on what it is you're going out there and buying. Right. So for instance, we can go, let's slide over here and let me bring up another tab as I don't have enough already. Let's pop over and let's look at some charts. So I want to show you a couple of ideas. So we talked about, for instance, USO. All right. I was going to get up on the big screen and do this, but I don't have the proper microphone to be moving around right now. I've had a lot of changes going on in my studio. So I got another mic coming in that's going to solve this issue. But check this out. This is USO. So USO, had this nice move up off of about 11.5. It peaked out just above 13.2. And when I say peak, keep that in mind because I want to show you something with what we call peaks later on in the program. Then we had the fallout, taking us from above 1320 all the way back down to just above 1170, and then we just started rebounding, and we're hitting some resistance levels right now today at the 1240 mark. These are short-term resistance levels. All right, I'm not too concerned about that. But if you look at buying 100 shares of this, you're talking about paying maybe $1,240. All right, so that's USO. All right, how about a stock like CVX? What's that going to cost for 100 shares of stock to hold for 5 months? All right. We're talking about now, it was 134. It's now down around 112. So you're looking at, 100 shares of stock. So you're talking about $11,200 to maintain a 5-month position here on a stock that, even though the market's rebounded, Chevron hasn't rebounded much at all. Let's look at XOM. All right. By the way, guys, I'm looking at these for the first time today. I did not pre-set up these XOMs and chevrons, and there's one that I pre-set up because there's one I actually like, but the other ones I haven't looked at. So, you know, it could have been, wow, this is a great trade, but these don't look that great right now. You see ExxonMobil has gone up to about 89, and it fell off, and it's sitting around in the high 70s right now. And I got to tell you, this does not look like something I want to jump right into, as it's still bouncing below the support level. Okay. But I wanted to just kind of quickly show you that. Regardless of what you know, you look at, the typical trader is looking at buying the asset. I'm looking at renting the asset, renting the Chevron or renting the Exxon, or more importantly, renting an ETF that's actually bounced off of that bottom and wants to move higher. Okay, so we'll talk about what that ETF looks like here as we move along. So the ETF that I want to look at, and I've looked at a lot of them, is XLE. So XLE is the energy select sector. Okay, it's one of the typical, I think 9 sectors that I look at across all industries in the market. And XLE is really a great way to take advantage of an increase in the price of oil. All right, and of course the energy markets. XLE is a group of energy companies, so it offers diversification versus trading one company. And here's the big point too. XLE doesn't have the kind of downward risk that an ETF like United States Oil or USO does. And the reason why is because XLE is a group of stocks where USO is commodities. It's mostly oil. There's a little gas and distillates mixed in there. But the one thing about USO, which ends up being a hurting, it hurts in the long run, is that the managers of USO, not only do they get their management fee, but they also are constantly buying short-term oil futures contracts, which have premiums in them. And those premiums drop as futures become cash. Okay, so think of it like a carry charge, a carrying charge that is a cost to store and ship oil. And that carry charge drops as you get closer and closer to the cash price. Basically, what it does is it weighs down that particular ETF, where XLE doesn't have that kind of downward risk. All right, so this is a chart of XLE, and you can see here that it has bounced off of its bottom, and we've got something here I'll talk a little bit later about called peaks. And so peaks are basically a proprietary support and resistance tool that we have built into Tom's tools. All right. A little bit different than channels because we're actually looking at several layers of support and resistance. And I like to call it static support and static resistance. Static meaning the line goes sideways. So as you can see here, which is really cool, the peak resistance level, it did exceed it and then come back down. But that really wasn't exciting to me as it was that we held the peak support level down here around just below 67. We sat on it one day, we crushed through it and came right back the next day, and it's been holding that support ever since. So this is really a great indicator that there's some support down here. The other thing you see is the volatility has actually moved higher, and it's much higher than it used to be. I mean, take a look in the middle of January. The volatility in XLE was trading in the low teens. All right, where's it at now? Oh, well, it was up in the high 30s, and now it's trading somewhere, volatility somewhere right in the middle, around 22. So it's not cheap, but it's not as expensive as it was just a week ago. All right. Another thing about XLE is that I ran money calendar patterns on this. So the money calendar, what the software does is it allows me to look at any stock or any ETF so long as it's liquid. All right, I don't want to look at something that nobody trades. I want to look at something that has a lot of volume and a lot of turnover between buyers and sellers. So that excites me because that means the crowd's in there. And the crowd, a lot of times, will move stocks up and down and does it in patterns. Okay, just like most of us wake up when the sun rises and we go to sleep when the sun sets. And most of us sleep on one side of the bed every day. And most of us have certain hang-ups that are patterns that happen over and over again in our lives. Don't think that this doesn't happen in the stock market too, because it does. All right. That's why I like this type of trading so much. The pattern I'm looking at here in XLE is that top line. There's a 28-day pattern starting here next week that has an 84% historical chance of moving higher. And that's what we did here. We ran the money calendar app. We set the target on XLE, and bang, this is what happened. So I see this, and this is just the beginning too, because this is a 28-day. This gives me an idea of what the first month is doing of this 5-month cycle. Now, I can get more information on this, and I see, yes, XLE, and it goes up, and this is all the data that I have at my fingertips, as well as anyone else that uses our Complete Trader or Professional Trader Toolpack. We have all data on practically every stock, every penny pilot stock for sure, and any stock that trades weekly options. So our target, based on everything we looked at with the money calendar, based on the fact that we're looking at XLE, we're looking at its target time, we're looking at its target price. It's projecting by mid-July to hit $75 to $80 a share. All right. Again, that's based on our 85% historical probability plus the average 15% jump in price during the regular cycle. Now, these things typically jump somewhere between 10 and 15% on a yearly basis. When it's on the low side, like 10%, that's when volatility is low. When it's on the high side, which is 15%, that's when volatility is higher, which is where we're sitting right now. Standard deviations, which are part of volatility, that's historical volatility. All right, standard deviations are high this year. So our target and our percentage and price should also be too. Now, let's talk about step 2. So we've spotted the opportunity. We all see it, okay? Now the next thing we want to do is create that low risk trade. All right, so that's the plan that we want to do first. And remember, I always use a 3-step approach when I'm trading any type of pattern, whether it's technical, whether it's fundamental, whether it's seasonal like the money calendar, whether it's like our darknet trades, which are channel collisions. Okay, spotting the opportunity is what we use for darknet, money calendar, etc. Next, I want to create that low risk trade. Now we're going to look at 3 different trading styles for XLE. First is a call option, all right? Call option gives the buyer the right to buy the underlying asset at a predetermined price over a predetermined time. That's calls, all right? The cost to buy the call option is referred to as the premium. And the cost and risk are no more than the premium of the call purchase. That means that's the most you can pay for, and that's the most you stand to lose, is what you put into the option, which is a fraction of what you would put into a stock. Now, with calls, I like, on average, not all the time, but most of the time, I like to be at that $5 or less on the call. I want to pay $500 or less. That's what I'm looking to do. So when I go forward and I look at call options, again, this gives me that total risk where I buy the lower strike. That's my worker, okay? That call option is my worker. I need it to work. I need it to work in my favor as the market moves higher. Okay, so I know the total risk is what I pay for it, but the target price, what I'm looking at, this question I get all the time, what's the right option to buy, Tom? Well, it's very simple. You look at your target price. You look at the strike price where you are now. And if the target price, the distance between the strike and the target isn't greater than what you're paying for that option, don't buy it. It's not worth it. All right, so we're going to do that math right now. So if you look here, this is trade number 1. This is an example here using XLE calls. Now, first of all, you're going to see that over here, I have the September options. The reason why is there are no Julys. So I don't want to go shorter term. That doesn't work. All right, I want to go past my time target. That way, in case I'm wrong or in case it doesn't go to that target, I still have plenty of time to get out and take what I can. But as you can see here, these are basically they're the at-the-money calls, all right, the 68 calls. And 68 calls earlier today, we're trading 425 by 440. Now, if I can get these for $500 or less for each call option, then that works for me, all right? But again, tell me, what's my target on XLE? Does anybody remember? It was 75 to 80. So if I'm going to pay 5 points for a 68 call, count it off with me. 69, 70, 71, 72, 73. That target price better be above 73. If it's right in the middle there, then I have a chance of doubling my money, and I'll show you how here right now. So I do something called what if. And our software at Tom's Option Tools gives you what if tables. Now I took the most minute, smallest, simplest part of the what if tables out, because we can do what if tables and you can look at things like delta, theta, gamma, rho, vega. You can look at all the Greeks. But I just wanted to bring out, for simplicity's sake, the what if tables on what happens with the price. So at expiration, if XLE is at 68 or below, I lose all my money that I put into those calls because they expire worthless. All right, that's the red line. If I look at the black line, if we get to 73 at expiration, then remember, if I paid $5 for my 68 calls, they're worth $5 at the end of September. All right, so at 73, I have a minimum value of 5, so I could break even there. But if we get to 78, those 68 calls are going to be worth a minimum of 10. If I paid 5 for those, that means I got a $500 profit or 100% return on investment. Okay. Next thing, trading the call spread. So we can buy calls, but let's look at a call spread. And a call spread is constructed by what? Buying a lower strike call and selling a higher strike call with the same expiration. And what we're doing is we're combining the prices. We're combining what we bought and what we sold. And again, the cost and risk of a call spread is limited to what you paid for the spread up to expiration. The maximum reward of a call, what you do is you take the distance between the strikes minus what you paid for the spread. I'm going to show you that here right now. So here's what a risk graph will look like. And we pulled this right off of our tools, tomsoptiontools.com. You buy the lower, sell the higher. And this is an example of buying a lower and selling a higher. And you can see what your risk is if the stock in question goes down. And then as the reward happens, you can see this actually starts to go into a profit potential. But eventually, it's going to hit an area where you can't make any more. And that's because you sold that higher strike. So you've capped how much you can make. Because again, with a call spread, what are you doing? At expiration, if you go through expiration, you're obligated. Well, you can exercise your long call. All right. You have the ability to buy at that lower strike. And guess what's going to happen on the higher strike? You're going to be obligated to sell at the higher strike. And I say this a lot. One of the reasons I love spreads is that when it goes in your direction, you can let it go into expiration. And I've done this, and I do this a couple times a year. This happens where these spreads go into expiration, and you have a decision. If you want to let them expire, that means you are buying the lower at the lower price, and you're being forced to sell it higher, and that gives you that maximum reward. So here's the XLE spread, and I actually have this on the Charles Schwab platform. So I blew it up so you could see it. This is at earlier today. So you can see here that this includes buying the September 21st, 2018 68 calls and selling the September 21st 73 calls. Now, look at the distance between strikes. It's 5 points, right? Remember how much the call cost? Yeah, it was 420 by 440, but you also got to remember that we were willing to pay up to 5 for that. So when it comes to a call spread, these longer term ones, you should be able to get this for half the price that you sold or that you bought the call for. So if I'm going to buy the call for 5 or less, I'd like to get this for $250 or less. So it's going to cost me half as much. So that's where when I go and I look at spreads, I'll look to those and I'll look to try to create something that's half the cost of what the call is. Now, I'll tell you what, the higher priced something is, the more likely you can get a call spread for half and even less than half of what that call costs. For instance, look at something like Priceline.com, which is not an oil stock by any means, but Priceline is so expensive that if you could see options in Priceline that cost $50, $60, $70 just for a call. And then you do like a 10-point or 20-point call spread, and all of a sudden that $50, $60, $70 comes down to $3, $4, $5, maybe $10, but nothing compared to the $70 strike for the actual call itself. So again, I like to see if I can get this for about half what I could do the call for. All right. So here's our XLE call spread. Now I want to show you something else. And by the way, it was $1.58 by 221. So it looks like that's easily doable by today's standards. Now let's do the what ifs on the spread. Now the what ifs on the spread are a little different because 68 and below, we still lose everything, but we only lose 250 instead of 500. All right. Now your break even is not 73. It's $70.50. Why? Because it's only 2.5 points above the strike year long. So you take 68 plus 2.5, and that gives you your break even. Also, my break even at expiration, I'm at break even. I don't have a loss, but I don't have a gain. But here's the other thing. look at the 73. This is 5 points above. So 5 points at 73 or greater at expiration. This spread's worth intrinsically $5. If you paid $2.50 for it, you now have something that's worth $5, which is a double. This is the part that's really important to understand for those of you that trade just call options. A double, but at half the distance of what the call did. All right. And that's, again, taking off the what if tables from Tom's option tools. Now, the third type of trade we can take with this type of pattern is a butterfly trade. And we refer to the long butterfly. This is a long butterfly, which means it consists of 3 option strikes. We look to buy to open the lower and higher strikes. Those are called the wings. And then we sell to open the middle strikes, which is the body. And then what we're doing is, you're selling to open, you're buying to open, and it's going to be done. And if we do this looking for a bullish move, it can be done for very little cost at expiration. So consider this area down here, for instance, where the stock is in question, whatever it is you're looking at buying. If you're going to buy just at the money or slightly out of the money, and you're going to look to sell, remember, the one you buy on the lower side, that's your worker bee. All right, that's the strike that's going to actually make the money for you. Up here in the 2 you sell, that's your income. You're taking that in. And then you've got this out here, this big one on top. This is protection. All right. So what does this look like when we put it to our XLE example? Well, it looks like this. The XLE butterfly could look like this. You could buy the 68, just like the 68 calls we talked about. You could sell the 73 calls, but you're going to sell twice as many of those 68 you buy. So if you buy one 68 call, you'd sell 2 73s, and then you'd buy 1 78. So keep in mind, the number that you buy on both of these outer wings has to equal the number that you sell in the middle. That's what a butterfly does. So that way you're not uncovered. You have 2 buys for 2 sells. The difference is that you've created a trade where now you're targeting the price more than ever. And in this case, if we can get to 73, right at around that expiration day, right, you're talking about something that, let's take a look at these quotes here. So 0 by $1.37. All right, remember the call we were looking to do for 5. The call spread, buy 1, sell 1, we're looking to do for $2.50. So I would look to do the butterfly for half of the actual call spread, $1.25. Is $1.25 doable when you look at the bid, the mid, and the ask? Absolutely. In fact, I think that one can be done. I think all of these can actually be done better than those limitations I put out there for you. But I'm just showing you these as examples of how you can take something and do more with it than buy the stock, or do more with it than buy a call option. Now this one, and we look at the risk graph on it. Well, let's look at the what if tables. So the what if tables look like this: the 68 or 78. Now you have 2 areas where you could lose. If you're below 68 or you're above 78 by expiration, you could lose your $1.25. But keep in mind, you're not losing $5. You're not losing $2.50. You're losing the butterfly price, the $1.25. So it's much smaller loss. If you are in between the 69.25 or the 76.75 areas, you're at break even or making money. Let me show you how we come up with those numbers. So take the lower strike, the one that we bought, and add $1.25 to that, and 69.25 is your break even. Take the higher strike, the 78, minus $1.25, and that's your high side break even. And everything in between these two is profit. The sweet spot is 73. Why is 73 the sweet spot? Well, look here. That's what you sold times 2. That's your income. So what's going to happen is, if you could be at 73, here's what it's going to look like. You're going to have a 68 call. It's going to be worth $5 at expiration. A 73 call, at the money calls expire worthless, and out of the money calls expire worthless. So this little 0 by $1.37 trade could balloon out to be as much as $5. And at $5, you've got a 300% return, because if you paid $1.25 for something that's worth $5, you have a $3.75 profit. Again, all taken from the what if tables. And I put some doozies out there for trades. All right. They weren't down the middle. They were worse. In a lot of cases, they were worse than the offers. Okay. So this isn't something where you can say, oh, those type of trades are impossible. They're not impossible at all. All right. And you can thank volatility for a lot of this too. A lot of what happened in the last couple of weeks has created some interesting opportunities for the next few months. So let's talk about an energy summary, and then I want to show you another pattern. So even the money calendar is a great 30-day tool. All right. But remember, it's not 100%. In fact, I was with our partners last year, and we did a whole analysis of money calendar in 2017. And, we're always looking at 90% plus days. All right. So 90% or better probabilities, historical probabilities, but we were around the 75 to 80% when it came to actually going through the year. And I was very happy with that. But, I'm always striving to do better and better each year. So that's one thing I want to mention. But here's the big thing. This particular pattern is not about a few weeks. It's about 5 months. Okay, that's the pattern. So it's longer term. Bullish energy opportunities will take longer than a month to work out. That's why we're looking at a 5-month pattern. That's why we're looking at options that expire in more than 5 months. And I want to mention something else too. And this is really important here. Rules-based trading continues to work better than anything else I've found in the last 30 years, especially what happened in the last 2 weeks. All right. I didn't stop trading in the last 2 weeks. The only thing I did was I tightened up what I was going to pay for my trades, and I also tightened up the amount of money I was going to put into each trade. And I am still a little bit on the tight side, but I'm starting to get looser now because I'm seeing this market start to revert back to the patterns that I expect happen in the marketplace. So, Jay, before I show these guys what we got kind of new that's happening in this next pattern that I want to show everyone, are there any questions that you see pertaining to the energy trades or the energy pattern we just spoke of?
I was just typing into Pat, who's asking about the exit on the butterfly.
Okay, so if we were to look back at each of these, call options are the easiest thing to exit because they go up faster than anything else. They get a higher gamma. All right, that's the Greek we refer to. Higher delta as we get into money, and the gamma is high, so that means that the delta changes its greatest. When you jump into a bull call spread, that gamma gets slightly reduced. Okay, with a butterfly, the timing now, because we're doing one that's bullish, all right, because we're actually doing a bullish butterfly, it's going to be a little bit different. And the reason I say that is because we're out of the money. So as it goes into the money, there will be money that comes in there. But if you really want to max out, then that particular trade has to mature as you get closer and closer to expiration. So it's not going to double in value as fast as a call or as fast as a call spread. It's more of a maturity type of trade. Anything else? You covering most of it?
Most of it, yeah. They're asking about the July options in soon.
Okay, well, there are not July options on XLE. All right, so that's, I mean, if there were July, we'd be talking about July right now. But there are June, and then they jump to September. All right, so that's why I chose September. But if you look at something like a Chevron or something like Exxon, or you look at OIH, which is another oil holders ETF, which I did not go into, these are products that have July options. So I wanted to show you an example of one that I really like. Just didn't have the option, the peak options that I want, but I'm okay. I'll go with the Septembers and put a little more time on my side. So speaking of peak, let me talk about what's new with our tools. So we have something called peak charts. I'll show you Money Calendar Trader, and then I want to show you cryptocurrencies charts, which are something that we put in brand new. And then I'm going to show you some of the coming soon stuff that we got going on. So let's slide over here. So first, if you see what I've got here, I'm actually going to bring this up and make this huge. And I want to show you peak charts. So peak charts now, the way to access these, for those that use our tools, if you look to the right-hand side, you just come down a little bit, you'll see an area that says Stock Chart Peaks. Just click on that, and it's going to put these horizontal lines out here, which are based on proprietary algorithms that we use to help determine what we feel are the best support resistance points. And I find it's really amazing, especially, and Jay, you'd told me to make sure I talk about SPY. Look at the peak chart for SPY as it came down. I mean, it went through some of the minor peaks, but then it dropped into 258. And I mean, hit it, next day bounced. And then we've been bouncing up ever since. And we closed on the high side of this little, which was, that's our now support becomes resistance peak. And so the next level we're looking at on the S&P is up here around 278. All right, which right now we're in the low 270s. So that's looking pretty good. And we did a lot of some short-term stuff. For instance, we had some trades earlier this week on the indexes like DIA, which doubled in value. We're using things like peaks to help us with those, as well as channel consolidations. Apple was one of the things that we looked at. We're bullish on, and I think we were bullish on that one a little bit over a week, but it finally came in. It was really a great value. We talked about that earlier this week on, it was actually earlier this week or late last week. We were discussing it on our professional trader live trade events that we do every week or every day, Monday through Thursday. We were discussing that. So that's peaks, and that's how you can click on those. Next, we talk about Darknet. I want to show you guys something in Darknet that I saw. This was amazing. I mean, Darknet just really killed it. So if I go over to our Darknet signals, and you got to be a level 2 to get Darknet, but check out pennies and weekly. So I'm going to highlight the penny and weekly stocks, and I'm going to search on this. Now, I want to show you a couple things. First, there's nothing today. You know why? Because Darknet is looking for channel collision buy signals, where if everything's going up like it has been the last few days, we haven't had too many channel collision buys. In fact, we're getting sells like, for instance, SDS. There's your buy. Here's your sell. All right, so that's SDS. And then there's TZA on here as well. Again, another one, buy here, sell here. But this is what I want to show you. Check this out. Go and just back up to, now remember Friday was a big turnaround day. We bounced off peaks, our peak supports. And so coming into the 12th, if you highlight the 12th, which was another big turnaround day, take a look at all of the buys on Darknet. By the way, these are the penny and weekly buys. But you could see stuff that was just, was just hopping. PepsiCo, buy signal. Look where Pepsi is today. British Petroleum, oil, buy signal. Look where BP is. International Paper. And then, and you can see where these have happened in the past. Let's take a look at Occidental Petroleum. There was a buy down here and a sell, and then it got another buy signal here at the beginning of the week. And it just goes on and on and on. Walmart's in here, gold is in here, Altria is in here. I mean, just a little bit of everything really started. We got channel collisions in 40 different penny pilot stocks. That's more than 10% of the penny pilot list that had channel collisions that happened on Monday. And the majority of these moved higher, as you can see. Look at this list of these 40. Only 2 of them actually moved lower. 38 actually moved higher based on the green squares that you see here on the screen. So incredible moves that happened with Darknet. Money Calendar. So we got Money Calendar, and this is great, but I want to show you something called Money Calendar Trader. This went out to all of our professional traders earlier this year. So, with Money Calendar, what we do is we go in and we click on the 15th. This is today, and we got all these symbols. Where do you go? I mean, we could sort by net profit, and we could sort by accuracy, and we could sort by average profit. We could sort by last loser. We could sort by power meter, which is one of our more recent things that really brings everything up to the top. But then when you go look at the options, and you start looking, who in here in the room has used the Money Calendar software, and you find a really cool stock trade, but then you go out and look at the options and you're like, wow, I just physically can't see how I can make any money on this trade, even though the pattern looks so good, because the options could be screwed up. Am I the only one? I see that. I mean, I spent a lot of time doing that, but here's how we solve that issue for a lot of the work. Click on Money Calendar Trader. All right. Now what we do here is we do the exact same thing with Money Calendar, but now the software goes in and it looks at the options and it sorts by options based on history. And then we have the sort method set to max return on investment. So this is today. So out of all those stocks that came up today, Home Depot. Home Depot had the best setup for options with a bull call spread as an example, looking at the average slippage, looking at everything across the board, and looking at everything from the ROI date, 90% return on investment, and how that would equate into the actual options. It was just such a nice setup. But what it did was it allowed me to look at Home Depot first, and then ignore all of the other trades that I had that were out there, and there were quite a few. So that's Money Calendar. So we looked at Peak. Again, we looked at Peak charts. We looked at Money Calendar Trader. Let me show you the cryptocurrency charts. So this has been like a big deal since around the holidays. I had more people asking me about Bitcoin over the holidays than I have ever since I started mining it in 2013. And by the way, just to let you know, I own Bitcoin. I own Bitcoin Cash. I own Ethereum. I own Litecoin. And I'm now getting into some smaller altcoins too. But the thing is that I wanted to give all of our tools guys a way to chart these right out of Tom's Tools. So to do that, all you have to do is in the charts, you just simply go to stocks, and then you'll see cryptocurrency down here. And then when you click on cryptocurrency, you're now going to see the big cryptos. Bitcoin, which by the way went over 10,000 earlier today. It's about, this thing was at $6,000 a coin last week. It's up over 50% just in the last 5 days. Ripple's back above $1. Ethereum is closing in on 1,000 again. This thing was trading around 600 last week. Bitcoin Cash kind of replicates Bitcoin. It's like a smaller Bitcoin. Then Cardano, which I don't really follow as much, and Litecoin, which traded below 150 last week. It's up to 211. But you can click on these little widgets and get more information on each of these coins, as well as charts on each of them. All right. So